Good evening, everyone, and welcome to our webinar for the month of October. So let me just start with the portfolio performance, starting with Coffee Can. So it's been a good month for Coffee Can with a return of about 3% for the month. If you look at the returns for the last 6 months as well, the returns have been fairly decent at about 20%, generating an alpha of more than 3% for the last 6 months. Talking about this month, the main contributors were Concord Biotech, Bajaj Auto, and Zomato, with impressive returns of 22, 13, and 9% respectively. In the bottom performances were PB Fintech, TCS, and About India. If we move on to Good and Clean. So Good and Clean for the month has given a return of about 2.2%. But if we look at from a 6-month perspective, the returns have been very, very strong at about 33.8% versus the benchmark of about 20%, which means that last 6 months, the alpha is in excess of 13%. If we look at this month, the contributors have been Blue Star, Chola Mandalam, and Balkrishna, with Blue Star actually giving almost a 21% return in the month of September. The bottom performances were from Aarti, KEI, and Emphasis. If we move on to emerging giants, for the month, been 0.3%. If we talk, the portfolio has slowly and steadily started bouncing back. So for the 6 months, the returns have been about 23.6 versus benchmark of about 20.2%. The main contributors in the month of September have been Neogen, which was up almost 40%, VMart, and VIP. In terms of the bottom performances, were from Mastec, Venus Pipe, and Orient Electric. Moving on to 10x, in terms of the 1 month performance, it's up about 1%. If you talk from a 6-month perspective, again, the returns have been impressive at about 26.7% for the first 6 months versus benchmark at about 20%. The main contributors to the return for the month were Bector's Food, Go Fashion, and Chola Mandalam. And in terms of the bottom performances, were from Venus, Orchid Pharma, and Aarti Industries. Now to talk about our newsletter, I would like to invite Trilok to come and speak on this month's newsletter. Over to you, Trilok.
Yeah, thanks, Bhargav. So, the point of the most contextual question that most investors have now is, what are we sitting at the interest rate cycle after a very, very long pause? Federal Reserve took a rate cut of 100 basis points, 50 basis points, sorry, in this month of September. Now, two questions that come to our mind: A, what does that mean for the outlook for both equities as well as interest rate globally? And two, what has been the historical correlation of such rate cuts for the cost of equities? So, A, to our mind, interest rate cuts usually is conducive for riskier assets, including equities, commodities, and other assets. Notably, the cost of equity that we use to evaluate a company keeps rising as the interest cost keeps falling. So I think in the next 6 months, we are probably poised for another couple of more cuts by the US Federal Reserve. And historically, it has been proven that unless there is a very big negative surprise in the US economy, you will see that benefiting the larger investors globally. Moving ahead, just a quick perspective on what has been the four major instances and what happened subsequently. So if you look at, these are the four major, late recent sort of rate cut cycle which we saw. And in most of these particular implications subsequently were lower cost of fund being an exceptionally strong driver for markets. Except for 2000 and 2008, where the interest rate cut also happened after the economic recession set in most of the scenarios, the market have delivered on constructive returns. And please bear in mind, we have showcased and shared a very, very long term correlation of interest rates with the multiples. As you will appreciate, multiples or P multiple is nothing but the earning yield, and earnings yield is inversely correlated to bond yield. So, to my mind, in the next 6 12 months, as we proceed further, there is a very, very high probability that this will eventually be a good news for countries like emerging markets, particularly India, which are at the leading front of earning growth. Moving ahead, these are the instances where the US Federal Reserve had cut rates and what are the implications subsequently for the next 3 and the 12 months time frame. Most of us would be aware such incidents, but you will be surprised to learn that 19 out of 20 times, yes, we heard it correct, nearly 95% of the time, the US markets delivered constructive or positive returns for the subsequent 12 months after the rate cut happened. When you look this particular data back home, the Nifty, for the instances that we have since 1991, this is a stark, similar pattern visible. Our numbers are 75% of the time we end up delivering a positive returns over the subsequent 12 months. From a very, very near-term orientation, the subsequent 12 months is again 80% constructive for Indian markets compared to global. Moving ahead, as we know that India GSEC yields and the 10-year GSEC yield were at the narrowest gap in the last 30 25 years, we think with the rate cut in the US and India also sort of maintaining the 6 to 6.5% repo rate cycle, our sense is the gap will widen in the subsequent 12 months, which is a fantastic news from a FII inflows point of view. In fact, this has been a question in the minds of investors that despite such great delivery of earnings, strong, robust economic growth, as well as great external factors, why is FII continuously selling India? To our mind, one of the most important answer to that is the cost of equities or subsequently the interest rate in the US markets. So as we proceed further with the widening gap between India and the US 10-year yield spread, we think the correlation is very, very strong. And as you can see here, this will obviously make a strong comeback as we proceed further. Moving ahead, also, as you will appreciate that with very, very low interest rates, and I explained to you in the beginning, it is a great conducive nature for the equities as a whole. With the falling interest rate, one thing is very certain that the multiple that you pay for a business certainly goes up because the cost of equity and the implications goes down. In fact, this is also visible if you look at the last 3 to 6 months. The quality and the growth have seen a comeback as visible here in the last 3 months in or right on the left hand side chart versus quality which took a back seat in the calendar year 23 or the FY24. And the main reason to our mind was abundant liquidity, and which we think will also now depend on where the earnings will reside, which is why our portfolios earning growth, if you look at whether it's coffee can, emerging giant, 10x or good and clean, will deliver very strong earning growth in the subsequent 2 years to come by, delivering in excess of 20 to 23% CAGR versus probably the best case potential of index to deliver 15% growth and with a very strong ROEs. I think there is no doubt that the earning growth will get us significant traction, and the companies who will not only deliver earning growth but also be in the top quartile in the Q1 Q2 will create alpha as we proceed further. With that, to my mind, this is just the beginning of the market's shift and the momentum focusing towards growth and quality. And the journey of the lower interest rates will be again a great news for those businesses who can deliver consistent growth along with superior execution. With that, I will move on to what's happening back in the local on the home ground. There are a couple of signs, or at least a couple of indicators which showcases growth moderating. First and foremost being the most tracked number in the country is the GST collections. As you would know, GST collections have tapered off, and thanks to also lower or moderating inflation, that GST is now at a 41-42 month low. Our latest data suggests that we grew at 6.5% growth in this particular month. But more importantly, the other aspect that you look at, particularly the rural market, we are seeing or witnessing signs of improvement, which is again a great news for a lot of our portfolios because we have already allocated or positioned for that kind of growth to come back. Also, on a broader banking sector, if you look at, there has been some signs of credit growth moderating from more than 18% to 13% as we speak for the latest fortnight that went by. However, to some extent, it is also moderated by RBI's guidelines slash observation for a lot of banking and NBFC businesses. Some other sectors are witnessing some slowdown, but to our mind, all the eyes are on the upcoming festive season, which is a very important demand indicator for the second half of the year. With a good monsoon behind us, we probably believe that the disposable income in the hands of an average consumer will be much better this time around, and going forward we will see demand particularly from a semi-rural and rural areas to push to come back. Now coming to earnings growth, we as we said and discussed, the earning growth for the Nifty and the broader indices will be 15 to 16% CAGR for the subsequent 2 years. But when you look at the details, which sector are driving that growth? Telecom and materials are the maximum growth driver for earning for this particular year, and energy and to some extent select discretionary, which is automobiles, will face the heat of decline when they're coming from extremely high base last year. Next year, we think it will be still spread out, but meaningfully skewed towards the communication and the metal sector again. So we think after a great 4 year CAGR of 20% plus for the Nifty, we are looking forward and settling at between 13 to 15% for the 2 years earning growth beginning next FY24. Looking from what's going to be happening from a yearly trend to the quarterly trend, I think the moderation in earning growth is certainly very, very loud and clear. And this particular quarter won't be very different. From the highs of 30% plus that we delivered a couple of years ago to single digit growth in the Nifty is a big driver for this is tapering of inflation. To our mind, except for food inflation, a lot of areas we have started to witness deflation in certain categories. And only businesses who have pricing power or can demonstrate superior execution will be the one who will overcome this slowdown in the earning growth profile for Nifty and the broader indices. We think, again, as I said in the beginning, uh, utilities and telecom, followed by retail, will be the driver of growth. More importantly, in the retail sector, to my mind, trend will be an outlier again in this quarter, as we have seen for the last 4 quarters in a row. Moving ahead, coming to valuations, obviously valuations in certain pockets have been punchy, but if you look at from a longer term averages, the P multiple of the index is now around 21 times, which is broadly marginal premium compared to the last 10 years of 20 and a half times. The price to book is looks at a little premium, but that's in my understanding and to our understanding is fairly in line because the ROE cycle has come up very, very sharply from less than 12-13% in FY11-12 to now at 16%. So one should also not ignore that aspect of improving profitability. With that, I would like to sort of commend my remarks on the macroeconomic aspects, and I would open the floor for Q&A, and me and Bhargav will be more than happy to address any queries that you may have.
Trilok, while we are receiving questions, understanding the broader market and given where earnings trajectory is and where valuations are, any thought process in terms of incremental asset allocation into our products, and what could be one area of focus where investors should look at in the current scenario?
So, thanks. To my mind, as we said, and I will also ask Bhargav to add to it. I think so. The growth differential will obviously have a big, perspective compared to what we are seeing, and we will also see businesses who can deliver much better compared to the business who are not. Before that, I think so. In the till time Q&A also assembles, I'll also speak about the good and clean portfolio. So this is so can you go back to the slide, please? Yeah, so this is just a brief snapshot of the portfolio changes that we have done in the portfolio, and you can see majority of the picks that we added to the portfolio has done remarkably well. Couple of them has just obviously delivered exceptional returns. So I will talk about maybe an example that will help you to understand why did we choose that and why we still continue to own it. We think Trend Limited obviously is when we bought one of the first names to enter in the portfolio. 2-3 things were very, very clear. A, the growth in the Zodiac format were actually very, very high in to the extent that they were actually doubling the store count every year on year. Second and most important aspect also that we saw is the proof was in the pudding from a operating model or store economics point of view. We saw the Zudio being the disproportionate growth driver because the company went on from becoming a less than 100 store franchisee in 2019, so 2020 to 550 store as it speak today. So the growth that this business has brought in because of the earning inflation has been a key driver for us to continue to own and reap benefits of the early cycle that we got in. Also, we had seen Westside consistently delivering meaningfully ahead of industry from a double-digit SSG growth, and we think that the story is yet to play out both from an earning growth point of view and the potential new, new segmentation that they will enter. The latest one within this company has been the introduction of the beauty segmentation that the company has entered this particular last particular week. So similarly, we can spare a minute and try and understand our perspective on why did we look at Blue Star Limited. So Blue Star Limited was the company that we entered because of two major reasons. Commercial refrigeration air conditioning was taking a big growth after a lull period of 5-7 years. And secondly, this is probably the only company in the country which have not lost market share for 7 years in a row. They have gained market share in the room air conditioning segment. Also, the margin profile for the business has moved from less than 4% to 8% in the last 6 years, again demonstrating their ability to withstand a hyper competitive industry and also at the same time be profitable on a unitary basis perspective, and market ended up appreciating the execution after the earnings just doubled in the last 2 years compared to doubling the preceding 5 years time frame. So these two, are just examples that I want to share, which obviously have done a great sort of contribution to the fund. And similarly, I'll just take one example of PVR Limited, where we exited the portfolio from the portfolios. The whole hypothesis was the content not being strong enough for people to flock onto theaters, apart from the fact that the ODD were also eating into the share for the consumers to go and spend and open their wallet in the theaters. So these were the quick changes and the impact subsequently on the Good and Clean portfolio. To our mind, the portfolio has already demonstrated a very strong performance in the last 2 years, and the portfolio construct is such that even if the upcoming time is volatile, we believe the earnings growth and the quality will demonstrate and overcome this volatile time in a very handsome manner. Moving ahead, I will just take a minute on showcase. Can you just move to next, please? I'll just showcase. This is the allocation of the portfolio across the sectors. As you can see, it's a reasonably diversified portfolio focused on mid cap, and importantly, gives you a fair bit of representation across large, mid, and small, but focus completely biased towards mid and large caps. And these large caps are the names which has eventually turned out to be from mid to large journey. TVS, Trent, and Chola that comes to our mind, which obviously have seen this journey in the last 18 months only. So we think this is obviously one of the best, one of the prime position portfolio for any volatility that will hit us. for any external and global geographical, geopolitical reasons. And also the growth is intact. So we think this is obviously going to be a great portfolio to invest from a 3-year point of view, apart from the other portfolio that we already offer to the investors.